Good morning, everybody. Happy Thursday. It's March 16th, 2023. Great to be with all of you today. My name is Bob Lang with explosiveoptions.net, and great to have all of you joining with me this morning. We do this every Monday and Thursday morning, right around 8:30. Had a little bit of a delay this morning, little technical difficulty, and was watching some of the data that came out this morning as well too. So I'm a little bit more prepared for our session here today. So it's great to be with all of you today. Don't forget, if you're in the March Madness pool, today is the last day to put your entries in. Actually, it was yesterday, but I think the first games don't start till about noon today. So if you're in the pool and you haven't made out your bracket yet, go ahead and do that. It's free to enter. Go to the website and you'll see the entry link on there as well too. Also, you can look at the market blast that I put out this morning about an hour or so ago. That has a link at the bottom to enter the contest. It's free to enter, but there's lots of good prizes to win if you beat me and if you have the best score among the whole group. So it's a lot of fun. All right, let's talk about markets here. So you can see here markets are under a little bit of pressure one more time. Yesterday, of course, we did see the futures drop sharply overnight, and there were some problems with Credit Suisse Bank. I think those problems have been known for quite some time. It just got a little bit more exasperated and came out of the woodwork here when we had all these banking issues going on over the weekend with Silicon Valley Bank last week, Signature Bank, and a few others as well. So again, a couple of years ago, I think Credit Suisse was a $14, $15 stock. Now it's a $2 stock, right? So this isn't anything new that we should be surprised about, right? This is a bank that A, does bad loans, and B, is bad management, and C, is just a bad bank, right? It's a big bank, and they're going to spin off one of their acquisitions from about 20-something years ago, First Boston, in a few months, but still, it's just a bad bank. And they ended up getting a bailout overnight. And if you remember your history about bailouts, just go back about 15 years ago when we had some banks that got steep bailouts as well too. As you recall, and I do remember this, that didn't work out very well at all. All right. In fact, if you remember, a lot of those bailouts happened in September, October of 2008, 2008. The markets actually dropped another 40% after that to their lows in March, about 4 or 5 months later. So, these aren't the solutions here. But what you can see here, and I want you to really focus in on here, if you go to the bottom left, you can see the VIX volatility index has been rising, right? I'm going to show another chart of the VIX in a few minutes, but you can see that the VIX is rising. The VIX futures are rising over here. And why is the VIX rising so much? It is because of the amount of uncertainty out there with this situation, this condition, right? And I know a lot of people realize that this whole banking situation hits right at the heart of the Federal Reserve. Yes and no. Obviously, they want to make sure that the banking system is stable, but still, the Fed has to remain focused, and they are, on reducing inflation in the economy. Because, if inflation takes hold and continues to be a problem, and we did see some fairly good numbers in the PPI yesterday, but we did not see good numbers in the CPI the prior day. Some decent numbers in the PPI just means that some pricing pressures are alleviating. So, but still, the fact of the matter is that inflation is still too high for the Fed, and the Fed needs to raise interest rates accordingly, right? So this is where we come at odds with the market right now. So I always like to say, the market is always right. That's certainly in the long term, but in the short term, I think there could be some things wrong here. So we see here's the Fed funds futures for next week's meeting. This is the 22nd of March. These numbers have been moving around quite a bit, right? Like yesterday, it was about a 50-50 chance of no rate hike over here versus a quarter point. Now it's 74% chance of a quarter point, only a 25% chance of no rate hike. Let's go up to May, and it's showing about a 56, if you add these two together, 56% chance of a 475 rate at the end of May, which would be no rate hike after one in March, 43% chance of another rate hike in May, and then we go out to June. This is really the odd one. It's showing a rate cut in June and also another rate cut in July, right? Down to 4.25. So from 450 to 475 to 5, back to 475 to 450, maybe even down to 4.25. I don't understand it. This is where the market, Fed funds futures market, is getting very wacky. I think we're going to have a lot more information. We are going to have a lot of more information next Wednesday after the Fed meeting, right? And after Jay Powell talks in the press conference, we're going to know a lot more. The last we heard from Jay Powell was when he testified in front of Congress and the Senate, and he implied that, look, you know what, we may need to raise rates faster at a faster pace than what we've been doing, and the markets got shellacked that week. Remember that. I don't know. I think this whole Silicon Valley Bank is a new situation. The market is trying to put the Fed in a box here, and I think they have to come out with some bold language and say, look, you know what, we're staying the course. We have to raise interest rates because inflation is just too high. And I understand, I get it. You know what? A lot of you out there wish they would stop. They would like them to have them pivot, have them pause, whatever, even cut rates. That's not the issue here. We have high inflation, and that is a long-term damaging effect to the economy, for the dollar, for you, the consumer, over a long period of time, right? Because those burritos that you buy at Chipotle that were $12 or $13 before, they're going to go up to 17, and they're going to stay there for years, right? Meanwhile, while wages are going up, they're not going up that fast. They're not going up 25, 30% for you it may take 7 to 10 years for your wage gains to catch up to the price increases that are happening on the consumer level. Does that make sense? I can't reemphasize this anymore. The Fed has to do whatever they can to sap demand and get interest rate, get inflation back down. And if it requires stronger, bolder rate hikes over the next several months, listen, they could always jack rates up to say 5.5%, 6% for 2, 3, 4 months, and really shock the economy and shock everybody out there in the investment world, and to stop spending. And boy, I'll tell you what, we could get some huge drops in inflation, and the Fed could start cutting interest rates again. But that's just my opinion. So on what they should do. So let's talk about markets here for a little bit. The S&P 500 chart. We always like to start talking about this. It's in a downtrend, right? So if you're trying to catch falling knives here, good luck, right? This is not a market where you are going to get rewarded or paid for buying, trying to grab at falling knives, right? The volatility level is elevated now. It's 26 to 27%. And if you're playing options, you know that volatility elevation means that option prices are expensive, calls and puts. So if you're going to try and catch a knife here and say, oh, well, let me just go ahead and grab some calls over here, you're really not getting paid for it, A. B, you had better know when to sit down when the music stops, because when that music stops, if there's no chair available for you, you're out of the game and you're going to lose money, right? So I'm looking at the chart over here. Lower highs, lower lows. We rallied back a couple of days ago. We tried to rally back yesterday. We do have a lower low from yesterday, from Tuesday's action. Elevated volume. You can see that right over here on the right-hand side. MACD still on a sell signal here. Relative strength, we nearly hit that 30 level. When we get to that 30 level, that might be an area might be interested for to buy for a bounce, but we haven't even got that close yet. You can see that happened over here. We hit that 30 level. We were up for a couple of days back in September, and then wham, we got slammed down a little bit more to hit those October lows. So it's not a guarantee. It's not necessarily a buy signal, but might be something you might want to step in on. Oscillators, let's take a look at that. We can see that the oscillators are down in pretty oversold territory, minus 282 on the NASDAQ, minus 261 on the NICE. And they went down a little bit yesterday, not as much as you would think with the poor breadth. Now, breadth yesterday, minus 2,300. to plus 676. That's atrocious, right? That is just unacceptable if you're a bull. Speaking of bulls, this is not a bull market chart here, is it? All right. I saw somebody making a comment saying that buy when there's blood on the street. Well, we might have had blood on the street back in September or June or May of last year. Okay, bear market moves. But here we are. We were at, these are new highs versus new lows. New lows minus versus new highs, minus 1100, minus 1000, minus 1200. We're only at minus 254 right now, right? Also, a chart that you guys know I like to look at here is the stocks above 50-day moving average. So let's take a look at that. And you can see that that's at a pathetic 21%. 21% of stocks are above their 50-day moving average, right? Which means that 79% are below their 50-day moving average. 79% of stocks out there in the S&P 500 are in bear markets. So over almost 400 stocks of the S&P 500 are in bear markets. Okay, so why are you trying to catch a falling knife? Wait till things start improving, right? I think one of the things that we all are worried about in trading and markets is that we're afraid that markets are moving so fast that we won't be able to catch up to it when things turn, right? And I get it, I understand that, I feel it sometimes myself. But I think what we need to understand is that markets trend, and momentum is extremely strong when markets are trending. And you have to understand that. If you prefer to be on the sidelines when the markets are going down, that's a good, safe place to be. Cash is always a good place to be. But if you prefer to play contrarian here, I think you're asking for trouble. You really do. I really think you're asking for trouble, especially when we're in the throes and the grips of a bear market. Yes, my friends, we are still in a bear market. Some of you may have remembered or heard me say this before. What is my definition of a bull market and a bear market? A bull market is one that goes up. A bear market is one that doesn't go up. Now, notice I didn't say a bear market is one that goes down, because a bear market could be one that goes sideways, right? We had that a lot back in the 1970s when I was a youngster. Back in the 1970s, stocks went sideways for years, and before they actually broke out in 1982 or 83. So a sideways market is going to frustrate everybody. Now, what if we had this scenario here that the stock market would go up or down this year within a 5% range, 5% up, 5% down, right? So we started at 3,800. What is 5% of 3,800? That's about 190. So you're talking about roughly, let's call it 4,000. Let's give it room to 4,050, right? Downside about 200 from 3,800 is about 3,600. So what if we were in this range of 3,600 to 4,000 all year long, right? That's going to frustrate everybody, because every time you think that we're going to break out, every time you heard somebody come on TV and say, that's it, it's a bull market, it's going to be a soft landing, this is it, we're going to go, we come back down again. Every time you see a move down to the downside, and it's, oh my God, we're going, it's Armageddon, we're going down to Chinatown, and all of a sudden we don't, and we turn right back up, go up 100, 200 points. That could be it. That could be it this year, right? And that's going to frustrate everybody, because we're not moving out, we're not moving up. We've had years like this where we had very, very tight ranges for the whole entire year. And believe me, I've lived through these things. It is extremely frustrating and very hard to trade. But that's what bear markets will do to you. They will mess with your minds. They will do this to you and make you crazy, right? And frustrate the heck out of you. As my good friend Jim DePore, RevShark, says, bear markets, they don't scare you out, they wear you out, right? And believe me, after a year like that, it would completely wear everybody out. So just a couple of comments there about that. Just, to keep your heads together, and just, the most important thing you can do is manage your risks properly, right? You use the bear playbook, and step back a little bit, have a little bit of control over the markets, right? And instead of letting the markets take control over you, right? Big difference. So that's going to be it. Again, I'm sorry I'm running a little bit late here today, but however, so we have a little bit of news coming out tomorrow. Some earnings came out overnight, and we have futures are down a little bit. Dow is down about 123 right now. I see some support on the S&P 500 down at around 3,800 to 3,810. We tested those areas a couple of days ago and bounced right back up. Now, of course, see the futures up 39.12, but the S&P 500 is going closed yesterday at 38.91. So we do have a little bit of a differential between the futures and the cash. That's due to the higher interest rates. I can explain that another time. I'm sorry. I had a question about volatility. So volatility, the VIX, and this chart right here. So I mentioned it yesterday. When did we first have a clue that volatility was going to come in? This was Thursday. This was the day. This big white bar here. This is the VIX. This is the volatility of volatility, right? It's its second derivative of volatility here. It tells you how volatile the markets are going to be going forward. So we've been having this decline in volatility of volatility here, the VIX of the VIX. But look what happened on Thursday here. This was the day before Silicon Valley Bank imploded, right? Somebody knew, right? It was a big, huge move in volatility. Now, the VIX didn't move that much that day. It moved a little bit, moved out 5%. But this was certainly a huge move, right? From 75 all the way up to 92, 20% move in the VIX of VIX, right? It continued on Friday, of course, Monday, and then Tuesday down a little bit. Yesterday was up quite a bit. So we see volatility coming up, and it's telling us that there's going to be a lot of big movements in the markets these days. Now, maybe that's counter to what I just told you about a tight range over here. Listen, you know what? 400 or 500 point range seems like a lot, but it's nothing for the S&P 500. But be mindful of this right here, okay? The 9-day volatility has exploded as well too. I can show you that. Right over here, see down, and you see the flat VIX futures term structure as well too. That is bearish. Look at the 9-day volatility. Of course, it went down a little bit, quite a bit yesterday, but 29%. That's big for 9-day volatility, right? And obviously, it's elevated because we have a big Fed meeting next week coming up in about five sessions. So we know that the market is going to be pricing in a big move post meeting here. But look down over here, historical volatility, which means the realized volatility is very high right now because the big movements. A week ago it was at 10, 5-day historical 5. Now it's at 18. It's almost doubled the realized volatility in just about a week or 2 weeks ago. So these are things to be mindful of. All right, be aware that the conditions are changing again, and play it accordingly. All right, have a great day, everyone, and I appreciate everyone listening over here. Enjoy your March Madness today and tomorrow, two of the biggest trading day basketball days for me of the year. I used to just turn off trading for the whole weekend, and then Thursday and Friday especially, and then just pay attention to basketball. But got lots to do today, and so do you guys. Have a great day, have a great weekend, and I'll see you on Monday. Thanks.